So what's the connection between a Chinese trade surplus that almost nobody is talking about,
Right.
a $5 trillion chip company fighting off import bans, and this wild idea that the government might actually force big tech to pay $15 billion for new power plants?
Well, these aren't just, separate little stories happening in different corners of the market.
Okay.
These are four massive global currents. We're talking finance, tech, energy, and geopolitics. And they are all crashing into each other right now. It's creating this silent wave of money, a hidden war over technology, and a huge reckoning for our power grids.
That's exactly it. We are going to dive deep into these flows of cash and power that are, fundamentally changing everything from the stock market to the price you pay to just turn on the lights in your own home.
Mm-hmm.
We are talking about a secret $1.2 trillion in private Chinese money just silently flooding into Western markets, like an accidental stimulus package.
Mm. And at the same time, right here at home, we're looking at a U.S. energy policy that could literally cost giants like Google, Microsoft, and Amazon billions of dollars for new infrastructure they are being forced to pay for. So our mission today is to connect all these dots, from, the decentralized money in China to the very centralized political power being used over global oil. We want to paint a single, clear picture of money, power, and the influence that ties it all together.
You have to identify these silent shifts, right?
You do, because that's where the hidden risks are, the things that can really impact your own economic stability, but they don't always make the front page headlines.
And here's why you really need to stick with us for this one. Stay tuned, because we're going to break down why the massive, just surging amount of power that artificial intelligence needs might soon make your electric bill absolutely skyrocket.
And crucially, who the U.S. government is forcing to pay for the $15 billion fix.
So let's start at the foundation, this colossal wave of cash coming out of China that's quietly keeping global markets afloat.
Okay, let's get into it.
All right, let's start with that huge number, $1.2 trillion.
Yeah, that number is really the core of this first story. China is, the world's factory. Last year, they had a record trade surplus.
Okay.
And what that means is a $1.2 trillion windfall poured into the country, mostly in foreign currency, dollars and euros.
And historically, for decades, really, the playbook was super simple, right? China earns dollars from exports, and that money flows straight to their central bank, the People's Bank of China, or PBOC. And then it shows up as official reserves.
That's right. And that gave Beijing this enormous centralized control. They could direct that capital exactly where they wanted it to go.
So if they wanted to buy U.S. Treasury bonds to keep their currency stable or, fund a project in Africa, they just did it. The government had its hand on the tiller.
Exactly.
But you're saying that whole system, it's not broken, but it's being bypassed now.
It's being completely bypassed. And that's what makes this so fascinating and, frankly, so risky. If you look at the official numbers today, the PBOC's reserves, they're basically flat. They're stagnant.
They're not growing with that huge surplus.
Not at all. Because most of that money isn't going to the central bank anymore. It's being held and, deployed by the private sector, or at least the semi-private sector.
Okay, so we need to define who that is.
Yeah.
The source material says about 2/3 of this money, so we're talking, over $800 billion, ended up with the non-official sector. Who is that? Is that just like a few billionaires, or is this still state-linked money just spread out?
It's a mix, but it's largely corporate. You're looking at the treasuries of huge Chinese export companies. They're just keeping their earnings in dollars instead of swapping them for yuan.
Oh, interesting.
It's also state-linked lenders, big regional banks, and, some very wealthy individuals. But the key point is, this is cash. The central government in Beijing doesn't directly control in the same way it controls its own reserves.
So this is a huge structural change. The plumbing of global finance is literally being rerouted.
It's a fundamental shift. We're moving from a very predictable, centralized system to what some analysts are calling a decentralized private investment footprint.
The old way was Beijing managing this huge pile of money.
Right. And now the money is just kind of seeping out quietly, following profit, not necessarily following geopolitical orders.
So if this $800 billion tide isn't sitting in Beijing's vaults, where on earth is it going? What are they buying with it?
It's being pumped directly into global capital markets, mostly in the West, and it's acting like a massive decentralized liquidity engine. This matters to anyone listening who invests or just watches the markets.
What does the data show?
Well, the data from just the first 3 quarters of last year is pretty staggering. The non-official sector's holdings of assets abroad, they jumped by over $1 trillion in just 9 months.
Wait, $1 trillion in 9 months? That's not a surge, that's an explosion.
It is. It's more than double the average annual growth they've had for the last 10 years. It's a massive, sudden repositioning of capital. And when you look at what they're buying,
Yeah.
you see a $535 billion surge in Chinese private purchases of overseas securities.
$500 billion. So what are we talking about? Hedge funds, real estate.
No, we're talking about the bedrock of the market. U.S. stocks, European bonds, mutual funds, these Chinese companies are basically acting as huge buyers, just injecting cash into the system.
Wow.
That increase, just through last September, was bigger than any full-year increase we've seen in the last 20 years.
So let me get this straight. Chinese companies and wealthy individuals are acting like a giant sort of semi-state-sponsored hedge fund?
That's a good way to put it.
And they're pumping hundreds of billions of dollars into Western markets. It's like an accidental, unofficial global stimulus program.
That's exactly what it is. And that liquidity is, helping to lift our stock prices, and it's keeping bond yields from flying even higher.
An analyst from Fidelity, Peking Liu, pointed this out, right? That as this private footprint grows, it's just going to become more and more important for global capital flows.
Precisely. And the big takeaway is that the global financial system is becoming, maybe without even realizing it, more and more reliant on this liquidity from China's private sector. If you're wondering why U.S. growth stocks have done so well, this silent tide is a big part of the answer.
Okay, this sounds great for my 401k right now.
Yeah.
But let's talk about the hidden risk. What's the danger here? What happens when the government isn't controlling the flow?
The danger is the decentralization itself, because this is private money. It's corporate cash that has to worry about profits. It's individual wealth looking for a return. It's really reactive. It can flow back out just as fast as it flowed in.
So it's not stable strategic capital like a country's reserves. It's hot money, basically.
You could call it that. It reacts to market conditions.
So what's the trigger? What would make this giant whale of cash suddenly swim back home?
The main thing analysts are worried about is currency. Specifically, a rapid appreciation of the yuan. Right now, the yuan has been pretty weak against the dollar, so it makes sense for Chinese exporters to keep their money in dollars overseas.
But if the yuan suddenly gets much stronger,
The whole incentive flips.
right, suddenly that $500 billion they have parked in U.S. stocks is worth a lot more if they bring it home and convert it back to their own currency.
Exactly. Chinese companies would have a huge immediate reason to repatriate that money, to sell their U.S. assets to buy yuan.
And if hundreds of billions or even $1 trillion worth of U.S. stocks and bonds get sold off all at once,
It would suck the liquidity right out of the markets. A massive shockwave. We would suddenly lose this huge reliable buyer. Bond prices would tank, yields would soar.
an analyst called it a fundamental directional reversal.
That's the perfect term for it. And the hit would be felt across the board. Stocks, bonds, overall stability. Because global finance has kind of quietly become addicted to this new unstable source of private Chinese cash.
We're basically dancing to a tune being played by Chinese corporate treasurers.
In a way, yes.
That's a profound thought.
Yeah.
And this huge reactive flow of money is chasing the biggest opportunities, and right now, nothing is bigger than artificial intelligence.
Mm-hmm.
So this financial backdrop is directly fueling the tech boom. But even as China's private sector is funding our markets, its government is locked in this high-stakes tech war with the U.S. over the very chips that make AI possible.
Which is the perfect transition. The battle for money is completely tied to the battle for tech.
All right, next up, we are diving into that escalating chip war between China's Manhattan Project and the world's most valuable chip company, Nvidia.
So we're shifting from the flow of money to the actual hardware that money is chasing. And at the center of it all is Nvidia,
The $5 trillion giant.
the first chip company to ever hit that valuation. And it's obvious why. They completely dominate the market for GPUs, the graphics processing units you absolutely need to train the AI models everyone is building.
They're basically the gatekeepers of this whole AI revolution. And for years, their growth story was all about China, right? CEO Jensen Huang himself said the Chinese market could be worth $50 billion a year to them.
50 billion. That's an unbelievable amount of money to just walk away from.
So losing that market is a huge threat.
It's a catastrophic long-term threat. And we're already seeing the pain. Even though Nvidia's overall revenue is just soaring, it was, what, $57 billion in Q3? Their revenue from China actually dropped because of all this geopolitical.
They're getting hit with a death by 1,000 cuts, regulatory-wise.
It's an impossible tightrope for them to walk.
And that regulatory confusion has just been a roller coaster lately. I mean, for a minute, it looked like things were calming down. President Trump greenlit the sale of Nvidia's powerful H200 chip to China.
Right, and the less powerful H20.
And in return, the U.S. would get a 25% tax cut on those sales. It seemed like a compromise.
That hope lasted for about 5 minutes. Almost immediately after the U.S. gave the okay, reports started coming out that Chinese customs were blocking the imports of the H200.
So wait, the U.S. says sell it, but tax it, and China says nope, we don't want it. Why would they block the very chips they desperately need?
It's a power play, a political signal. The Chinese government might be showing its anger over the broader U.S. restrictions, or maybe, and this is key, maybe they're trying to force their own domestic companies to use local chips to speed up their self-sufficiency plan.
Whatever the reason, it puts Nvidia in a terrible spot.
An extremely precarious position.
So how are they responding to the chaos?
With some really tough defensive business terms. Reports say that for any Chinese clients who want to buy the H200, Nvidia is demanding full payment up front with no option to cancel.
Whoa. So you pay for the chip in full, knowing there is a good chance it might get stuck at the border forever.
Exactly. They're basically shifting all of the regulatory risk onto their customers. That tells you just how unstable that $50 billion market really is.
It's a scramble to lock in revenue. But the real long-term threat here isn't just this current friction, right? It's China's all-out effort to just build this stuff themselves, their so-called Manhattan Project.
That's it. This isn't just about importing chips anymore. For China, it's about technological sovereignty. They are pouring resources into domestic alternatives, and they claim they can match or even beat Nvidia's performance soon.
And that name, the Manhattan Project, that's not an accident.
Not at all. It's meant to signal the same level of urgency as the U.S. effort to build the atomic bomb. It tells you that Beijing sees this as an existential issue.
And this isn't just one or two startups in a garage.
Oh, no. This is a massive state-funded mobilization. You've got giants like Huawei and Alibaba in the game. You've got highly funded players like More Threads and Metagex. And while their chips are still behind Nvidia's today, that gap is closing fast.
But even with all that effort, analysts say Nvidia's true Achilles heel isn't their hardware, it's their software. This is the Utinia nightmare you mentioned.
This is the absolute core of Nvidia's power. It's not just that their chips are the fastest, it's that they built this whole proprietary software world around them called CUDA.
Right.
Think of CUDA as the operating system for AI. It's what developers use to actually program the GPUs efficiently. It has all the tools, all the libraries.
So if the GPU is the engine, CUDA is like the hyper-advanced transmission and control system that lets you actually use the engine's power.
Perfect analogy. And it creates this incredibly powerful lock-in effect. Because all the best tools are on CUDA, all the developers use Nvidia.
And since all the developers use Nvidia.
No one wants to spend the time and money building tools for other less used platforms. It's the ultimate competitive moat. It's like the dominance Microsoft had with Windows for decades.
The cost to switch for a company building a huge AI model must be astronomical.
It's basically impossible. They've built their entire infrastructure on CUDA. Moving to a new platform would be a massive business risk, so they just stick with Nvidia no matter the price.
So, if China's goal isn't just to build chips that are as good as Nvidia's, what is the nightmare scenario that could actually break through that $5 trillion moat?
The nightmare scenario is that Chinese developers who are forced to use their own domestic chips because they can't get Nvidia's, they will be forced to build their own software alternative to CUDA, a really good open source one.
So the U.S. trade restrictions could backfire. By locking them out, we're forcing them to innovate their way out of the problem.
Exactly. And if they create a powerful open source AI software platform, one that can run on lots of different kinds of chips, Chinese, American, whatever, then the CUDA lock-in is gone.
The whole moat just evaporates. And suddenly those Chinese chips, even if they're a little bit slower, become a totally viable option.
And not just for them. Eventually, global competitors like AMD and Intel could use that open source software too, eroding Nvidia's advantage everywhere. It's a case where a policy designed to protect U.S. dominance could end up creating its biggest long-term threat.
A huge geopolitical tightrope. And no matter whose chips win this race, they all need one thing:
Massive amounts of power.
And that's where we're going next. From the fight for the chip to the literal, physical battle for the electrical grid. The demand from AI is now starting to hit home for consumers.
Which leads to a really interesting question for everyone listening. Do you think it's fair for big tech to be forced to pay for new power plants? Or is that government overreach? Let us know what you think.
Okay, that question brings us right to probably the biggest domestic energy fight happening in the U.S. The AI boom means a data center boom, and these data centers use just an absolutely unbelievable amount of electricity.
And this isn't a future problem. This AI power crisis is happening right now, and it's starting to affect regular people.
How so?
Well, U.S. households are already paying record prices for power. Part of that is fossil fuel costs, but now you have this new competition. When a giant data center comes online, it needs huge, steady, round-the-clock power.
And it's competing with me and you for that same limited supply.
Exactly, and that just pushes prices up for everyone.
And the epicenter of this whole crisis seems to be in one specific region, the PJM interconnection region. What exactly is PJM?
So PJM is a huge grid operator. They manage the power grid for over 67 million people, from the mid-Atlantic states like Pennsylvania and Virginia all the way out to Ohio and the Midwest.
And crucially, this is where the world's biggest cluster of data centers is, right? In Northern Virginia, Data Center Alley.
That's right. So they are on the front lines of this demand surge.
And what are their forecasts looking like?
Alarming, to put it mildly. PJM expects their peak electricity demand to jump by 17% by 2030.
17% in just a few years. That's insane. Grid planners usually plan for, what, 1 or 2% growth a year?
It's an emergency. You cannot absorb that kind of demand spike with the existing system. You either build massive new power plants immediately, or you face the real risk of rolling blackouts and crazy price spikes for every single customer on that grid.
So the government is stepping in. The Trump administration, along with the governors of key states like Pennsylvania, Ohio, and Virginia, they've cooked up this unprecedented plan.
It's a major intervention. The plan they've agreed on is to direct PJM to hold an emergency wholesale electricity auction.
Okay, what does that mean in plain English? How does an auction force big tech to pay for power plants?
The idea is that in this special auction, tech companies, so think Microsoft, Google, Amazon, would have to bid on 15-year contracts for new power generation.
And these contracts would fund the construction?
Yes. They're designed to support the construction of about $15 billion worth of new power plants.
$15 billion, financed directly by big tech.
Here's the really unprecedented part, the part that has all the force. The tech giants would be forced to pay for that power for the full 15 years, whether they actually use the electricity or not.
Wow. So it's not an option. It's a non-cancelable long-term contract. It's basically a guaranteed revenue stream for whoever builds the power plant.
That's the whole point. It takes all the financial risk out of building a new plant, which makes it possible to get them built very, very quickly.
President Trump's position was pretty clear on this. He said big tech companies have to pay their own way.
The government's logic is simple. If your industry is the one causing this massive, sudden demand crisis, then your industry is the one that has to pay to fix it.
I mean, it's a clear logic, but it raises huge questions about government overreach, doesn't it? Is it fair to force a private company into a 15-year infrastructure contract?
It's a massive legal and political question. It might solve the immediate crisis, but it's a huge government intrusion into the market. Critics are already saying it's the government picking winners and losers and basically imposing a special tax on one industry.
And you have to wonder what precedent it sets. Could they do this for water systems or roads?
For sure. And you can see the tension in how this plan was even announced.
How so?
A White House official laid out the plan, but PJM, the actual grid operator that has to make this happen, well, they seem to have been kept out of the loop.
The grid operator wasn't on board.
A spokesman for PJM, Jeffrey Shields, basically said that PJM representatives were not even invited to the announcement event.
It's incredible.
Yeah, he just said they don't have a lot to say on this. The fact that the organization in charge of the grid was left out of its own emergency plan announcement, that suggests some serious friction. It was a political move first, and an engineering plan second.
The whole story is really about powerful groups using leverage to get what they want. And that same dynamic is playing out on the world stage in the oil markets.
It is. From fighting over electricity for data centers to fighting over access to crude oil, the playbook is surprisingly similar.
All right, let's now look at a huge, controversial oil deal brokered by the White House, where big money and political connections seem to be front and center.
Yeah.
Okay, so now we're shifting into pure geopolitics. The setup is this. The U.S., right after the capture of Venezuelan leader Nicolas Maduro, puts together this very controversial but strategically important plan to sell up to 50 million barrels of Venezuelan oil.
This is a huge deal. It's about taking a hostile nation's main asset and using it to try and stabilize global oil prices.
And whenever a huge new supply of a resource like that comes online because of a political move, the first question is always, who gets the first slice? Who gets the deal?
And the answer in this case was Vitol, one of the biggest and most powerful energy trading companies in the world. They got the very first U.S. sale of that Venezuelan crude.
Now, on the surface, that makes sense. Vitol is huge. They can move oil fast. The Department of Energy even said Vitol was chosen because they could get the deal done expeditiously.
Right.
But there's a massive red flag that makes this whole story way more complicated.
And this is where the political money comes in. The source material shows that a senior oil trader at Vitol, a man named John Addison, donated about $6 million to PACs backing President Trump's reelection.
And that included a huge $5 million donation to the MAGA Inc. Super PAC.
Which instantly made him one of the biggest Trump donors in the entire Houston energy world.
The optics are bad enough, but it's the timing and the proximity that's really stunning. Addison was actually at a White House meeting with the president just last week, right as this whole Venezuela deal was being put together.
And at that meeting, he reportedly told the president that Vitol would get the best price possible and that he would make sure the president gets what you want from the Venezuelans. Now, Vitol's official line, of course, is that the donations were a private matter for Addison and that it had nothing to do with the deal.
It's the classic defense you hear in these situations. But you can't ignore the sequence of events. A huge donation, a White House meeting, and then a priority deal for the donor's company.
You can't. And when the media started asking questions, the administration pushed back hard.
What was their defense?
A spokesperson, Taylor Rogers, basically called the whole thing a tired attempt to distract from the incredible work of brokering this historic energy deal. They tried to pivot away from the donor connection and focus on the geopolitical win of taking down Maduro.
So we have this strategic win on one side and a huge conflict of interest question on the other. But zooming out, this isn't just about one shipment of oil, is it? It's about long-term control.
That's the biggest takeaway for the global energy market. The White House has been very open about this. They plan to control Venezuela's oil industry indefinitely.
So this is a strategic takeover. It's about influencing global oil prices and weakening OPEC power by controlling a major non-OPEC supplier.
Exactly. And the U.S. is now encouraging Western oil companies to invest $100 billion to rebuild Venezuela's oil infrastructure.
Yeah, $100 billion.
And to make sure that investment happens on U.S. terms, it's all being backed by a naval embargo of the country. It's a complete takeover of a nation's most valuable asset, from top to bottom.
It's a perfect example of how power works. You use political leverage to get economic control, and then you use political connections to get the ball rolling financially.
And a company like Vitol is right at the center of that, selling that Venezuelan oil into the global market and reinforcing U.S. influence over the price of crude.
Which brings us to a final question for you listening. When a powerful company gets a priority deal right after making a massive political donation, is that just how business is done in Washington? Or is it a hidden risk to the whole system, creating a clear conflict of interest?
So we've covered a lot of ground today, from, decentralized Chinese cash to a software war to a forced $15 billion power plant deal and finally a politically connected oil deal.
They seem totally separate.
They do, but if you connect the dots, there's a really clear common thread. Power, whether it's financial, technological, or political, is consolidating. It's getting more concentrated. And because of that, the hidden risks that's in the system are just growing.
We started with that $1.2 trillion silent tide of Chinese cash, which is quietly making Western markets dependent on a really unstable source of funding. Then we moved to the tech war, where the fight over the H-200 chip is actually pushing China to build its own Manhattan project that could one day destroy Nvidia's biggest advantage, its CUDA software.
And that tech race has real physical costs right here. The insane power demand from AI is forcing the government into this unprecedented move of making big tech pay $15 billion just to keep the lights on for everyone else.
And finally, we saw how raw political access, fueled by a $6 million donation, can land a company at the front of the line for a huge strategic energy deal, giving the U.S. indefinite control over Venezuela's oil.
The old rules of global business and politics are being rewritten, and it's happening so fast and often so far out of public view.
It's incredible to think that the rise of artificial intelligence is driving not just a tech war, but a literal physical war for energy. A world where a software platform like Nvidia is a geopolitical weapon.
And where the need for data centers is forcing billion-dollar political actions.
It really leaves you with a final, provocative thought to chew on. If the need for AI is already so huge that it's raising consumer utility bills and forcing governments to make these drastic moves, are we actually prepared for the true physical cost of an AI-powered future? What else are we going to have to pay for to keep this revolution going?
A big question.
That's it for this deep dive. Thank you for joining us. We hope this has helped you connect some of the major forces shaping our world today.
Yeah, we really encourage you to keep exploring these stories on your own.
And if you found this useful, be sure to subscribe and maybe share it with a friend who wants to understand where the hidden risks are hiding. We'll be back soon.